And welcome back, options traders. Hello, everyone. And a special welcome to all of the new traders who have joined the group here in the past week. Had quite a few of you. It's great having you here. Earlier in the week, I posted a video on the trend, and in a related way, there's some other indicators out there that are all part of a collective family called market internals. And the two that I'm talking about here are the TICK and the TIKI, or as some people say, the TICI. So these aren't really all that widely used, but they're a very handy formula to use and to take a look at to give you some indications if we're about to see a market turn. So let's take a look at these, the TICK and the TIKI. To understand these, you have to back up a little bit and understand what a tick is. And in the financial markets, a tick is the smallest unit that an underlying can move. So for the stocks, for example, it would be 1 cent. And if the price moves higher from one trade to the next, that's an uptick. And if the price moves lower, it's a downtick. Now, there are a couple of special cases that apply to this, but they're easier to show with an example. So let's take a look at some ticks here. Let's say that the market just opened and our stock starts trading here for $100 per share. That's the very first trade of the day, or what we would say is the first print to hit the tape. But then we have a second trade go off, probably within a fraction of a second there. It's at 100.05. Keep in mind that just because the tick size is 1 penny doesn't mean it can't trade for more than that. That's just the minimum. Our third trade prints at 100.05 as well. Fourth trade drops to 100.04, and the fifth trade at the same price. So how do we read these ticks? The first one right here, going from 100 to 100.05, is called an uptick, and that's just because the price increase between those two trades. Between the second and third, however, it didn't increase, but it also didn't decrease. So that's a special case that we actually call a 0+ tick. The 0 in that phrase means that there was no change between those two prices, and the plus in that phrase means that if you go back far enough, that you would find that the last time it did change, it was an uptick. So that's again called a 0+ tick. The fourth trade right here actually did drop. So that's called a downtick. And then you've probably guessed this last one right here is called a 0- tick. So that's some of the terminology that you have to understand. So if you're looking at the tick, it just applies to the NYSE, the New York Stock Exchange. And it's a very simple calculation. You're going to take all of the upticks and subtract all of the downticks. Just a straightforward count. Upticks minus downticks. If we're looking at the TICI, it's exactly the same thing. It just applies to the Dow. Upticks minus downticks. So how do we read this? Well, I'm going to use the TICI for the example just because there's 30 stocks in the Dow. It makes it a little easier to conceptualize. But it would be exactly the same thing for the NYSE or any other number of exchanges or indices. With today's technology, you can find these calculations on nearly any exchange or index, but most traders are going to be talking about the NYSE or the Dow. So keep in mind we have 30 stocks in the Dow, so the easiest thing to think about is that if we had an even split, 15-15, we're going to get a TICI reading of 0. So that just means we have 15 upticks and 15 downticks, or 15 0+ or some combination versus 15 0- ticks or some combination between the downticks and the 0- ticks. But it's 15 to 15, so we subtract them out, get a reading of 0. If we start getting some advancing, we might see 16 to 14. Of course, we've always got to add up to 30. So now the TICI is going to show +2. If it goes 18 to 12, it's +6. Of course, if it reverses, we might see it go negative. We might see 10 advance and 20 decline, and the TICI would show -10. So it's interesting now we can put these up on computers. We can look at them in different aggregation periods, depending on the broker that you have. But let's go over to the Thinkorswim platform and see how this works during a live market. So here's a look at the Thinkorswim platform, and we're looking at the DJX, which is just a 1/100th index of the Dow. So here's what it looks like over the past year. This is a day chart. But just to show you something else neat you can do here, I can come up here to the aggregation period, choose my time frame, let's go to intraday, And I can actually go down to the tick level, and I can aggregate it by different levels. It doesn't really matter. People get very hung up on these. A lot of these are based on Fibonacci sequences. I can also grab this slider bar. But once I have an aggregation period, choose OK, and it's going to actually go down at the tick level and show me what's happening in that period, whatever we're looking at. So I can come up here and change that to maybe, let's say, today. And let's go down maybe to a 1 minute candle. So there it is, 1 minute time frame. So pretty neat. But again, it's a handy little tool to give you some insights when you might be seeing some short-term reversals in the market. So now, having shown you that, let's come up here and take a look at the tick and the ticky. I'm just going to do $TICK, and in the drop-down menu, you can see right there, $tick, NYSE tick. Choose that, and that's what's going on in the NYSE. Now again, just to make it a little easier to see what's happening, I'm going to go to the Dow. So we're going to use $TIKI, and right there at the top, Dow Jones Industrial Average tick. Choose that, and let's go ahead and zoom in here to make it easier to see. So take a look at this last candle right here. Even though these aren't really stock prices, Thinkorswim aggregates them according to candles, just like you would with a stock price. Or actually, in this case, we're in a 1 minute candle. Let's jump over to a 5 minute and zoom in here. So now this is, you can think of it as a 5 minute window. We open every 5 minutes and we close, and that's what we're looking at in this candle. So right now, if this were the closing time right now, this would be the current level, the top of this candle. And I know that because the candle is green. And what level is it? Well, it was 12, but that's because we had a net 12 advancing. Now you can see we've gone negative. I've got net of 14. So if you take the advance minus the decline, we're coming in with minus 14. And now we've jumped back to positive 6. So you can see they're quite volatile, which makes sense because every single second that stock could be ticking up or down. But we're just going to go back and forth with this. And you can see during this 5 minute period so far, we've had a high, looks like about maybe 26 to the plus side. During the same time frame, we've had a low of about almost 28. But right now we're positive, and that's why the candle is green. Now it just went to a doji. We're basically flat, actually about minus 6 right here. So this is just going to carry on back and forth until that 5 minute period is over, and then it's going to shift over and create a new candle. So if we look back at this previous candle, we can see it's red, so it was down. So this was the opening. This was the tick at that opening period. This was it at the closing. That's why the candle's red. The close is below the open. This was the high, and this was the low. So it's a very good and interesting way to get a feel for what's happening in the markets. Are we getting more buying pressure, or are we getting more selling pressure? If those are your questions, take a look at the tick and the ticky. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. I also have some mini trading tutorials on courses like volatility and the Greeks for those who want more focused studies. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.